Hey guys, what's going on? It is Denise Donoghue, the Mortgage Nerd. It is January 2020. Holy cow, how did that happen so quickly? I am going to give you a current market update where I think interest rates are headed, where they are now. It's a big year. We've had a lot going on, especially recently with everything that's going on with Donald Trump and Iran. So let's get started. Currently, where interest rates are now is for those of you who haven't tuned in before, how a mortgage lender predicts what's going on with interest rates is by watching what you see on the screen here, which is the bond market. No, I don't expect you guys to be mortgage owners yourself, but what's important is when you see the candlestick high on the chart, that means interest rates are low. And when you see the bonds low, that means the price of that means mortgage rates have gone up. So if I zoom in on this, in fact, let me bring it up with what I have online. You can see that this is where rates are, or this is where bonds are now. We've seen a slight increase in these bond prices, which is what's caused the interest rates to go down. If we look at what they've done over the last 3 years, or even what they've done even in the last 2 years, this was November 8th, 2018. And so basically from November 8th to 2018 to where we are now, we see a slight increase, not a slight, a big increase in these price of bonds, which is why for the most part of last year, interest rates had come down. So if you have friends or family that purchased or refinanced a home in the 2017, 2018, now is the time to send us a recent copy of that mortgage statement. We'll run a refi analysis for free. It doesn't require any kind of credit pull or anything like that because rates have come down. And if I fast forward over just the last month, you'll see that they've been somewhat steady, even with the news last week. They've been pretty steady. So we're going to keep a close eye on this. I update our mortgage interest rates on our website every single Friday, so be sure to tune into that. What are some of the rate projections going on? So Q1 all the way down to Q4, you have different entities like Freddie Mac, Fannie Mae, the Mortgage Banker Association, NAR, and basically they're predicting what interest rates are going to do for the 2020 year. And what's pretty crazy, even though it's an election year, they're predicting that mortgage rates are going to stay pretty consistent. There's not going to be a whole lot of up and down, which is great news. If you've been thinking of selling and buying this year, now's the time to do it because interest rates are staying low. We don't know where they're going to be in 2021. We do have an election year. Usually, I will tell you an election year causes the bond market to go kind of crazy. So again, we'll keep a close eye on this for you and keep you guys in the loop. Here's just another chart to look at in 2016, 17, 18. We see that interest rates went up was what I just showed you guys. 2019, we saw interest rates came down. And it looks like in 2020, they're going to stay pretty flat. Now, I've never actually in the mortgage business seen interest rates stay flat the entire year. So I highly doubt that that's what is going to happen. But what I do think is that it's going to be little ups and downs, not drastic up and downs, which is kind of what everybody was thinking was going to happen last year. Moving along, if we take a look at what economists predicted the recession. So if you guys remember my chart at the beginning of last year, economists were predicting a recession in 2020. And this prediction, which is this chart here, that prediction was over 50%. So economists were predicting that the recession was going to take place in 2020. And now it looks like they're pushing that back because that number has dropped from 50% down to 34%. 2021, people are projecting it to be 29%, and then you see a big fall off at 2022 and beyond. So probably, if I was a betting man, the recession is likely going to take place either this year or next year, but keep in mind, a recession is not going to be like the 2008 housing crash. It's not going to cause your home to depreciate in value. Appreciation rates are just going to slow down. So lately, over the last 5-6 years, appreciation rates have been hovering around 5-6% nationwide. They might come down closer to the healthy rate of 3-4%. So again, that doesn't mean that homes are depreciating like they were in 2008. It just means they're not appreciating as much or as fast when a recession hits. So I think that that's important to know. Also, they ran a survey to see out of all the investments, which ones do Americans still find is their safest? So you can see real estate here is the 27.2. You've got your savings accounts, which is 21.8. Then you've got gold, which is what people voted as 16%, US bonds and US stocks. So what's crazy is that our savings account rates are below the inflation rate. And so even though Americans think it's the safest investment, you're still safely losing money if your interest rate in your savings account is lower than the inflation rate, because your purchasing power is decreasing every single month because your interest rate isn't keeping up. So keep that in mind. Now, what I really wanted to dive into, and this would be a good section to share with your kids, or if you've got any college grads that are coming in the middle of this year, what does owning a home really do for me? You guys know that I am a numbers nerd. People say owning a home is good, but who actually quantifies it? Well, that's what I'm going to do for you guys, because I think when you quantify the numbers, it really puts things in perspective. So the first thing is that every single month when you make a mortgage payment, there's a portion of your payment that goes towards principal. So this is probably really tough to see, but on an estimated loan of 350,000 at a 4% rate, making 12 normal payments a year, no additional principal payments, your principal and interest portion of the payment only would be 1,670. Of that payment, on your first mortgage payment that's due, that's what this amortization chart is here. In this column, you'll see that your first payment, you'll have $504 going towards principal, which means it's that in our world we call it like a forced savings account. It's kind of like putting it into a savings account, but it's bringing your loan balance down. So when you go to sell your house, you have more equity. So there's $504 that go back in your pocket. On your second payment, it goes to 505. Your third payment, it goes to 507. And that's because the way an amortization table works and schedule works on a 30-year mortgage, every single month, a little bit more will go towards principal and a little bit less will go towards interest. And so what I want to do is run an analysis that says, okay, here's a $350,000 loan, payment 1670. Let's fast forward us in 5 years and see how much in principal you'd have back in your pocket, and then factor in appreciation and compare it to rent. Because rent prices, everyone focuses on how home sales have been increasing, but take a look at this. Since 2012, the rent prices have been skyrocketing. So they were around 1,300 in 2012, and look where they are now. They're right at about that 1,600. So one of the biggest attractions with owning a home is that you can lock in that payment, and you're not, subject to your landlord or the apartment complex constantly changing the price on you. So let's assume though your rent payment stayed the same over 5 years at $1,600 a month. And let's assume that you took out a $300,000 loan. And I'm going to assume a 4% appreciation. Basically, what this is telling you is that after year one, you're going to have $12,000 in appreciation at the end of year one at a 4% rate. And you would have put down $5,283 in principal. At year two, that appreciation climbed to $24,480 and the principal climbed to $10,781. When we fast forward to year five over here, you'll see that your total appreciation at the end of year five is almost $65,000. So that's like the profit of you owning a home. You bought it for $300,000. Now it's appreciated to $364,000 at the end of 5 years. Plus, you've got $28,328 that you would have paid in principal every single month. So at the end of the year, you would have had, at the end of five, you would have had $28,000. That's a total profit of $93,324. For a lot of you, that could wipe out some student loans that you have. Versus rent, you pay $1,600 in rent. We're assuming that didn't increase, which is not likely. At the end of 5 years, you would have nothing from that, and you would have spent $96,000 in rent at the end of 5 years. So you could spend $96,000 and get nothing in return, or you could get $93,000, which is a game changer. And I am starting an interview process with people, with financial advisors, CPAs, because I'm really passionate this year about quantifying the wealth that real estate can do. And the number one thing that I hear clients say when we pre-qualify them for that third, fourth, fifth house, Their biggest regret is that when they bought their first home, they didn't keep it and turn it into a rental. So think about that. If you guys bought a home years ago, what is that worth today? If you are currently renting and you ask your parents, hey, what was the price of your parents' first home? My parents bought a home in Highland Village, Texas for $67,000 and it's worth close to $400,000 today. That is crazy. And it is a dated, small, like 1,600 square foot home. Crazy. What kind of game changer to their worth would that have done if they would have just kept it, turned it into a rental? That's what we are strategizing our clients and helping them because my goal is to help people build wealth in a different way than maybe our parents and grandparents taught us. So thanks for tuning in. If you guys have any questions at all, you know how to get a hold of me. Just go to www.themortgagenerd.com. Take care.